call. Stay connected. The call will begin shortly. Participants, you are connected to the Affle India Limited earnings conference call. Kindly stay connected. The call will begin shortly. Thank you. Ladies and gentlemen, good day and welcome to the Q2 and H1FY23 earnings conference call of Affle India Limited, hosted by Anand Rathi Share and Stock Brokers. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Mr. Shobhit Singhal from Anand Rathi Share and Stock Brokers. Thank you, and over to you.
Thank you, Rutuja. Good morning, everyone. On behalf of Anand Rathi, we welcome you all to the Q2 and first half FY23 conference call of Affle India Limited. I take this opportunity to welcome the management of Affle India Limited, represented by Mr. Anuj Khanna Soham, who is the Managing Director and Chief Executive Officer of the company, and Mr. Kapil Bhutani, who is Chief Financial and Operations Officer of the company. Before we begin with the discussion, I would like to remind you that some of the statements made in today's conference call may be forward-looking in nature and may involve some risks and uncertainties. Kindly refer to slide 26 of the company's Q2 earnings presentation for a detailed disclaimer. I will now hand over the call to Mr. Anuj Khanna Soham for his opening remarks. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining the call today. I trust that all of you are keeping in good health. We achieved robust organic growth in the first half of this financial year, despite the ongoing global headwinds that have impacted businesses globally. We closed this quarter with our highest quarterly revenue run rate, highest conversions, and highest EBITDA, anchored on our Affle 2.0 growth strategy, tech innovations, and sustainable long-term value creation. Affle delivered year-on-year organic growth revenue growth of 29.1% and PAT growth of 39.6% in Q2, and revenue CAGR of 61.2% in Q2 over the last 3-year period, much ahead of the industry growth trends. Our CPCU business noted a strong momentum, delivering 64.7 million user conversions during the quarter, an increase of 32.7% year-on-year at an INR 51 CPCU rate. In terms of H1 FY23, we achieved year-on-year revenue growth of 64.4% and PAT growth of 61.4%. And this was well supported with balanced organic growth over the first two quarters. Our sequential growth was approximately 10% higher on revenue in India and similar trends in other emerging markets, and 2% higher on revenue overall in Q2, and a clear trend of bottom line margin expansion on both quarter-on-quarter and year-on-year basis. Our resilient performance in these testing times is a testament to our ROI-linked CPCU business model, the broad-based balanced growth, and strong on-ground teamwork across global emerging markets. However, we did see negative impact of the global headwinds in developed markets, US and Europe. If not for the negative impact in developed markets, we would have potentially earned around $3 to $4 million of revenue more in the first two quarters of this financial year. To mitigate this short-term impact, we have also realigned our execution strategies and operating resources to focus on improving our platform-level pricing and profitability, as well as maximizing our strategic partnerships and overall productivity with even greater emphasis on bottom-line margin expansion and cash flow growth. Now, as per our understanding of the trends in the industry forum discussions, the near-term industry growth outlook across global markets is pegged at approximately 10% sequential growth in H2 versus H1, as more advertiser budgets are getting unlocked and balanced over the festive quarter and Q4 of this financial year. Affle's strong organic growth momentum in H1 should enable us to beat any short-term industry trends in H2, and we can realistically aim to end FY 2023 with year-on-year organic growth percentage aligned with the long-term industry growth of 25% CAGR over the next few years. Given our asset-light platform-based business model, it is reasonable to expect margin expansion, and thus our overall growth percentage on EBITDA and PAT in H2 will be significantly higher than our growth on revenue. In view of our long-term optimistic growth outlook of 25% CAGR, we are continuing to invest in our organic growth operations, and we are also actively evaluating inorganic growth opportunities in line with our Affle 2.0 growth strategy and execution track record. We are placing even greater emphasis on value-driven strategic investments based on bottom-line financial fundamentals and cash flow returns, and we remain optimistic about our bottom-line growth for this financial year. Our focused execution on Affle 2.0 strategy, anchored on the 2 V's and the 2 O's level partnerships, have enabled us to drive deeper verticalization for our advertisers. This has further strengthened our moat, and our direct customer contribution has continued to be stable at 74% of our revenue in H1 FY23. We further established our industry thought leadership position by winning the prestigious Enabling Technology Company of the Year award for the 4th consecutive year at the MMA Smarties India 2022 and several other campaign awards at industry events. To reflect upon our platform strengths, we have also included 3 case studies in our earnings presentation focused on omni-channel solutions for our customers in retail, entertainment, food tech sectors and emerging markets. With that, I now hand over the discussion to our CFO, Kapil Bhutani, to discuss the financials. Thank you, and over to you, Kapil.
Thank you, Anuj. Wishing everyone a good day. In Q2 financial year 2023, the company reported revenue from operations of 3,545 million INR, a growth of 29.1% year-on-year. Sequentially, we have, while our overall revenue has increased by 2%, we have a significant revenue growth of 10% in India and similar growth trends in other emerging markets on a quarter-on-quarter basis. Except for the developed markets, which anyway has much lower contribution for us on a consolidated basis, our business across emerging markets remains resilient and strong bottom line growth momentum and margin expansion. Our EBITDA for the quarter stood at 723 million INR, an increase of 38.8 YOY and 5.3% growth on quarter-on-quarter basis. EBITDA margin stood at 20.3% in this quarter versus 19% in Q2 and 19.8% in Q1 sequentially. We are focused on higher profitability, margin expansion, This quarter, our EBITDA margin crossed 20% plus after a 4-quarter period, with the profit after tax also slightly notched up. In terms of OpEx, inventory and data costs stood at 62% of our revenue from operations, witnessing improvement over our last few quarters trend. Our employee benefit expense for the quarter increased sequentially due to investment in human resource focused on business development activities and some currency adjustments. Further, we also rolled out our platforms in other regions, including LATAM region. Our normalized PAT for the quarter was 587 million, an increase of 39.6% YOY. Normalized PAT margin increased to 16% versus 14.9% in Q2 last year and 15.6% in previous quarter sequentially. We remain focused on working capital management. Our cash flow from operations and collection efforts has been robust. We are not seeing any increase in credit loss risk. In regards to our balance sheet, you would have noticed a significant increase in the line item, that is other financial assets. This increase is on account of fixed deposits having a longer tenure of more than 12 months and thus classified as non-current. As an update on our investment on Talent Unlimited Online Travel Limited, i.e. Bobbles, this investment continues to be classified as held for sale by the board of the company, while we continue to maintain 26.24% stake in Bobbles. Looking ahead, we remain confident of long-term growth prospects and will continue to invest in our organic growth as well as evaluate inorganic opportunities with well-calibrated focus on higher bottom line growth for the financial year 2023 and beyond. With this, I end my presentation. Let us please open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to only use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shobit Sengal from Anand Rathi Share and Stock Brokers. Please go ahead.
Yeah, thank you. Good morning, sir. So I have a few questions. So given the macroeconomic risk globally and especially in US and Europe, so have you seen any ad budget cut from our clients? And what are the sentiments? And how do you see the second half of this fiscal? And second question is, how much Jampp contributed this quarter as compared to last quarter? Thank you.
Thanks for the questions. I think in my commentary, I'd already provided actually quite a lot of detail on what's the impact of developed markets per se. Now, the way we should look at it is that Affle's business is in a very privileged position because of our deep focus on India as well as other global emerging markets. And because of that, we are continuing to see a very clear growth pattern in India as well as in other emerging markets, on a sequential basis. When we compare Q1 to Q2, we see a very clear sequential growth pattern in India, and that pattern is also similar in other emerging markets. Now, in developed markets, and because of that, a lot of the investors are saying, how come Affle is so immune to what's happening? We keep on growing. And I think we have a differentiated business model, emphasis on emerging markets, and that keeps us reasonably insulated and privileged from what's happening. But there is definitely a negative impact in the global developed markets, primarily in US and Europe. And we have also in this commentary quantified that. We said that, look, if not for the macroeconomic global headwinds, we believe we would have earned $3 to 4 million additional revenue in the first 2 quarters in H1 this year. Now, even without that, I think our performance is very resilient. But you see, if in case the budget cuts or the impact of the global headwinds was to be not there, we would have actually earned $3 to 4 million more in H1, and that would have been even more phenomenal in terms of results. Now, then that comes to your second part of the question, right? What's happening in H2, right? What should we expect in H2? And we have also given a very clear direction there that overall in H2 we expect to see that the industry growth outlook, based on our assessment of the discussions in the industry forums, and we are plugged into so many industry forums, we're listening to our competitors, we're listening to what's happening across all markets, and we understand that the industry growth outlook is pegged at around 10% sequential growth in H2 versus H1. So even with the macroeconomic risk factors, we will still continue to be growth oriented. And as far as Affle is concerned, I mean, obviously our growth momentum in H1 year-on-year basis is quite substantial. And on a sequential basis also, we have seen that Q1 to Q2, we have been able to keep a good growth momentum overall, at least on the global emerging markets. And with the fact of the festive season, the festive quarter, as well as the balanced budgets that the advertisers are looking to increase over the festive quarter as well as Q4, it is reasonable to look at 10% sequential growth. And even with that, we are already emphasizing that our focus on bottom line margin expansion profitability would absolutely ensure that our EBITDA and PAT is, growth is better than the revenue growth because of the bottom line sensibility and focus and the asset light business. So every incremental growth is obviously leading to better margins and profitability. So with that, I think I would like to answer the question at that. Now, with respect to Jam, I think we are already looking at the situation where last year Q2 we also had Jam. This year Q2 we also have Jam, and the balance is very clear that there is 100% organic to organic comparison. There is no need to split and slice and dice into Jam versus non-Jam. But qualitatively speaking, Jam is more calibrated on developed markets than rest of Affle's business. So there is impact, and we have quantified that. But overall, as a group, now as an integrated proposition, we are seeing clear advantages because we are also launching our other products and use cases in Latin American markets and so on and so forth. So there is a lot of positive synergy in the year two of Jam in terms of business expansion and bottom line performance. So we are quite satisfied with that. Can we take the next question, please?
Thank you. The next question is from the line of Abhishek Bhandari from Nomura. Please go ahead.
Hi, Anuj. Anuj, I have two questions. First is, your investment in...
I'm sorry to interrupt you, Mr. Bhandari. May we request you to speak a bit louder? We cannot hear you.
Is it audible now?
Yes, please go ahead, sir.
Okay, sorry for that. So, Anuj, my first question is on your investment in Cash Karo. If you would explain the rationale for that investment and how do you think, that investment adds to your, business moat, maybe from a medium to long-term perspective. That's one. Secondly, on the Bobble, I think you mentioned in the opening comment it has been classified as a financial investment, and I think there was a press release which suggests that, the deal with Capton possibly has not yet concluded. So maybe you could, update on what's happening on that particular one. Thank you.
All right. I think both of these questions will be answered slightly differently. The first one is actually not an investment of Affle India Limited. It's not part of the list co. It is an investment. It's a financial minority investment made by the holding company from Singapore. And since the holding company has no other operating business other than its investments in the Affle India Limited as a promoter, as well as any other investments that is doing which are financial in nature. So that is to the extent I can speak with respect to Pouring Pounds, which is the entity, which is a UK-based entity that owns the business of Cash Karo India. And with respect to any strategic advantages or so on with respect to Cash Karo's business in India, that our teams are actively exploring, and everything else being equal, I think there will be natural inclination for Cash Karo and Affle India to work together since they have a common shareholder in the holding company. So I think that's to that extent. I think the second one is a more relevant question because it is linked to Affle India's investment in Bobble, or rather Talent Unlimited, which owns and operates under the brand of Bobble in India. And yes, it is an investment that's held for sale for certain reasons. I mean, but at the same time, the Krafton deal hasn't happened because Krafton is a Korean company, and as a Korean company, they have their own shareholders. They're a public listed company in Korea, and there are certain complications with respect to the transaction. Therefore, the closing didn't happen as per the time. In fact, we extended the closing once, and the closing still did not happen. And therefore, at the moment, we are not pursuing any further discussions with respect to Krafton as a potential buyer of that equity. We are going to explore further possibilities as the time unfolds. We are happy to maintain the 26.24% ownership until we find an honorable buyer who would actually close the transaction. So that's pretty much it. And I think from a strategic point of view, Bobble continues to be an important partner and a vernacular keyboard focused on innovative youth-related use cases. And then we are actively working with them to see how to grow that business.
Thanks, Anuj, and all the best.
That answers your question.
Yes, Anuj. Thank you. Thank you, and all the best.
Thank you. The next question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah. Hi. Hope my line is audible. I have one question on the growth side. So you were mentioning, Anuj, something about the realigned strategy. If you could elaborate a little bit more on that. And to your comment of H2 growth of 10% over H1 would imply 18-19% growth on a YOY basis for H2. So I understand that delivering this would itself be credible given the kind of macros we are having. But in that light, is it fair to assume that FY24 growth should be slightly lower organically, while the CAGR aspiration of 25% here may remain over a 4 to 5 year period?
All right. I think on your first question on realigned strategy, I think the core strategy is the same. When we talk about realigning the operating resources, I think we are essentially talking about deeper focus on pricing and profitability. So I did comment on that, right? I said, like, what does that mean, right? And how do you decode that, right? So whenever there is recessionary, conversation or backdrops, there is intuitively pressure on pricing. And I think one of the things that we're doing is very strongly defending pricing. Even if you look at in Q2, I think we delivered our highest volume of conversions, but we held our pricing at 51 rupees CPCU, which is actually quite a commendable effort by our team. And similarly, focus more on profitability, right? Not just picking any business, but pick business that is going to deliver profitability, pick business that is going to deliver cash flow and credit risk managed business, right? So I think we are looking at the quality of business being made even more resilient in these times, and therefore delivering a better impact on the bottom line. Same thing applies to, this is a great time actually to look at any better optimization where we can maximize the profitability of the company. So same applies to all the assets that we're integrating, whether it is Jampp or any specific organic or inorganic activity that the company is doing. The emphasis is disproportionately higher on bottom line focus. We have always been a bottom line centric company, unlike many other fast growing tech companies. I think that's one thing that differentiates Affle, and that is what our investors also value and take pride in. So that is what we are emphasizing here in terms of even deeper realignment on bottom line focus while the time is. The second part of your question is about growth. Now, what I said is about 10% is the industry growth outlook that we have understood based on the industry forum discussions. We would love to beat it. We have always loved to beat industry average growth, and whatever the times be. And from a bottom line perspective, we think that we will do even much better than that, significantly better than that. So overall, we will end this year hopefully at a honorable, very honorable level. Hope meeting or exceeding expectations from a bottom line perspective by any standard. Now, like H1, we have already grown quite nicely, right? And next year H1, I believe that you should follow a similar trend, and we will continue to be optimistic because of the emerging markets focus. I think there is reason to be optimistic. And in H2, if as per what you said, the growth is going to be what it is, I think on a lower base, it's actually easier to grow much faster. So I think I would still maintain that FY24 or 25, the outlook for the company, I mean, as long as I'm leading the company, we will continue to want to beat industry average growth comprehensively on the top line and even more so on the bottom line. So without giving any more detailed guidance on it, I think you can understand the mindset with which we are leading the company. It's growth oriented, it's profitability oriented, and we will want to beat industry average growth trends even this year. If you combine H1 and H2, our goal would be to not miss on the 25% organic growth long-term trend that we have. So yes, markets are turbulent, but can we be stronger? Can we be more resilient? Can we find those pockets of growth? And the answer is yes, and we're pushing our teams for that. So until the last day of the year is on, we'll be fighting for every single dollar of revenue and every single incremental dollar of profit. So let's see how Q2 and H2 unfolds. And for next financial year, we have 2 more conversations to go. But at the moment, I would not look at it with any further clouds of pessimism or anything like that. I think the industry growth outlook with consumers going more and more digital, emerging markets trends where even when there is recessionary pressure, let that pressure be on traditional media. No, I mean, if advertising budget has to shrink, let it shrink on traditional media. The digital should stay. Even if digital has pressure, at least CPCU should thrive. So I think we should be, more and more insulated, and we should find those pockets of growth is my thesis, and that's how we're executing.
Just a small clarification. Yeah, just a small clarification on the margin comment that you made. Is it led by a better growth in H2 and in general better margin in H2, or is also building some potential acquisition from Jam?
I think we are seeing Jam. Year 1 was about integrating together. I think we have done that. We've done that phenomenally well. So when I speak Affle now, I speak with the full embrace of Jam. And when we are talking about expanding the margin of the company, I think one is linked to volume. As our business is growing, I said we are asset light business. Our expenses will grow slower than our revenue growth, right? So therefore, there will be natural margin expansion trend. But as a strategic emphasis, we're also focusing on pricing and profitability, which means that we are picking business or picking only the volume of business that can support the profitability metrics and not give any volume-based discount, because that is where the pressure comes. When people are looking for, hey, give me something cheaper because hey, there's a recession, there is a need for our product. There is a need for driving conversions with consumers for all our customers. What they are sometimes looking for is, can they get it cheaper in this time, which means, it impacts pricing, it impacts profitability. So how do we aim for growth, but also play a very strong defense play, right? So I think, so being offensive and growth oriented is one, but making sure that we are, even more strong on our defense than our offense in these times is the strategy. And I hope that is understood well, and that applies to Jam, it applies to every single part of Affle's business.
Okay,
Thank you. The next question is from the line of Anmol Garg from DAM Capital. Please go ahead.
Yeah, hi. Thanks for giving me the opportunity. Actually, I just had a couple of questions. Firstly, just wanted to ask Anuj that we are implying a 25% type of, we are talking about a 25% growth for FY23. Now we have already in the first half, we have done around 35% organic growth. So would it mean that seasonality of 3Q will not play out in this year? That is first. And secondly, wanted to ask a bookkeeping question from Kapil. That in this particular quarter, we have seen forex gain into our cash flow statement by the tune of around 37 crores. So if you can highlight what was in regard, what does it regards to, and how does it comes out in the P&L statement? Thank you.
All right. Thanks, Anmol, for your question, and very, very insightful. Let me first of all clarify that when I talk about growth or any growth percentage or the industry, I'm only talking organic growth. Now, H1 versus last year's H1, this year's H1 is last year's H1, had one difference. In last year, Q1, we did not have JAM. In this year, Q1, we had JAM. And Q2 to Q2 comparison is, absolutely clear because in both the quarter twos, we had JAM. So when we talk about growth, right, as an industry, we say the industry will grow at an average CAGR 25%, and we're talking about, organic growth, right, incremental organic growth. In our case, we have given you two commentaries. One, for the full financial year, our goal is to attain organic growth of 25%, which is the industry average CAGR growth trend that we are looking at. And we are always long-term trying to keep pace with that or beat that, right? That excludes the Q1 with respect to JAM. Then I've also given you some industry outlook with respect to Q3, Q4 seasonality. And whenever there is seasonality, there is obviously incremental budgets. But the customers are also hedging and they are careful. So while the budget is incremental, they may not spend all of that in the same Q3 festive season, but they will spread it over Q3 and Q4. So therefore, what we are looking at is H1 versus H2, and seasonality's incremental budget will have a spillover effect in both Q3 and Q4. And we expect that the industry would, on an average, deliver 10% higher sequential growth from H1 to H2, and we hope to meet that or beat that, right? That's on the revenue side, but then on the profitability side, we hope to, beat that more comprehensively. And that's exactly what I said. So the outlook on that, I hope the math is more clear. And it is not that, hey, we have already grown, quite well in H1 overall, over 35%. And then, will we see a muted seasonality? But I think we have given very clear commentary anchored on industry outlook as per our understanding. In terms of your second question, which is forex statement, Kapil, I think you can take this up because it's directed to you.
Yeah. Thanks for asking this question. This pertains largely to assets getting revalued, the foreign assets on the person. And it has been offsetted mostly from the reserves, opening reserves, and it does not have an impact on the P&L per se. Right? So it is an adjustment of each line item, whether current, non-current assets or current or non-current liabilities, getting flowed into the balance sheet and getting offsetted in the reserves and surplus and OCI, right? And it is not routed through P&L.
Sure. Just follow up on that. If Anuj, you can also highlight that what are the margin levers that we can think about in for the second half of this year?
I think the sorry, can you hear me?
Yeah.
Okay. The margin levers are anchored on a few things. One, ensure that our pricing is resilient. Second, ensure that enough volume and growth to meet or exceed the industry trends. And in combination of that, keeping a tighter, balance with respect to that every incremental revenue that has come at healthy pricing should not, the OPEX increase has to have productivity and efficiency, which means that even though we are consistently investing in our own growth, and you can see, even in Q1 to Q2, you would see that our OPEX is increasing. And a lot of people say, hey, hold on a second, isn't there recession time? Why are you increasing your OPEX? Look, we believe in the long-term industry growth trend, so we'll keep investing to ensure that we can capitalize on that growth trend, and we are well resourced for that. So therefore, when we look at it with this balance, pricing first. Second is the enough growth and volume with respect to incremental budgets for H2 versus F1. Third, the asset light business and scale on bottom line expansion will also come in because our OPEX is not going to increase and keep pace with the growth in revenue. So this is exactly what we saw in Q2 this year, whether you see it sequentially or you see it on year-on-year basis. And the same trends, I think, will continue in H2 as well and beyond. And all the investors who had earlier got confused, Affle is growing fast, it's an asset-light company, how come we don't see margin expansion? There was always organic margin expansion, but because we were also acquisitive and we were acquiring companies that were less profitable, in the previous year periods, it was averaging itself downwards because the organic growth and the inorganic growth was being blended together. Now, when you see Q2 to Q2, there is no inorganic in Q2. It's Q2 compared with Q2 last year or versus Q1, and you can clearly see the pattern of EBITDA and PAT margin expansion. So those are the levers, and it's a very natural expectation. I mean, whatever I'm just saying is something that should be a common understanding with all our shareholders.
Sure, Anuj. Thank you. I'll get back in touch with you.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah, Anuj, two questions. One, to an earlier question by a participant, you made a remark that in 24 and 25, you are looking at that organic growth of 25% plus, and you aim to beat the industry so long as you are in leadership of the firm. So was that just an off-the-cuff remark, or is there anything, a change in leadership is in contemplation?
There's no change in leadership contemplated. As long as I'm healthy, fit, and fine, I hope to lead the organization for decades to come. I think the nature of that comment is to be interpreted that I'm giving you a peek into my mindset. How do I set targets for this company? How do I tell my leadership team? How do I convince them that, hey, many times we have a very strong leadership team, and this is not just a one-man thing that Anuj says something and everybody has to follow. I think we have a very vocal leadership team, including Kapil. Many times we are challenged and debate ourselves. And this is my mindset. I say we're growth oriented. We have to beat the industry average growth rate to our team. I said, line of questioning is, are we better than the rest of the players in the industry? Are we competitively stronger? The answer is yes. Is our business model unique, differentiated? The answer is yes. Emerging markets, is there growth? The answer is yes. So why won't we beat the industry average growth rate? That's how I set the targets for the team. And therefore, the emphasis that because a lot of times this conviction has to be delivered top down, and we have to live by that example. And therefore that comment. I don't see any leadership change that would be dramatic. Our company has been led consistently for last 17 years, and I'm still a very young man. I'm only 44, so there's a long way to go, sir.
Sure. And I just wanted to be clear about what that remark was supposed to mean. Thank you for that. The second, while it's understood that Affle is a far greater focus on emerging markets, India and other emerging markets included, and developed market is a smaller percentage, and yet that smaller percentage is rather quickly face some setbacks. The question that begets is the developed market, the space, the speed and the way that market seems to be getting muddled. Why? What are the structural reasons why you believe and remain confident that the emerging markets and the developing markets would continue to provide not only resilience but a strong long-term superior growth?
Well, look, I'm very confident about two things. One, the consumer adoption curve on digital. And these are fundamentals of our industry. These are the fundamental drivers of our industry. And I believe that all of us on the call today can reasonably safely say that none of us is leaving the mobile device or our connectivity on the mobile device anytime soon for the next 3 years or 4 years. And the next generations in our home, the younger generation in our home is spending even more disproportionately connected time online. And therefore, the adoption curve of connectivity in India, in Africa, in Indonesia, in Vietnam, in Thailand, Malaysia, Philippines, Middle Eastern geos, Latam, all of these places, we will see massive consumer adoption over the next 3 years or 4 years. It will continue to happen. And the propensity for transacting higher value, higher volumes of transactions on mobile or connected devices will actually go up. So that is one of the main anchors that I see for emerging markets to have resilience and growth for many years to come. The second trend that makes me very sure about this is that the advertisers in emerging markets are still under-calibrated on digital versus developed markets. In developed markets, digital is decisively more than 50% of the total ad spend, whereas in emerging markets, it's, depending upon which market we look at, it's either in the 20-odd% or the early 30-odd%, but it is nowhere close to being above 50%. So the advertisers will need to also face the reality and shift budgets to the more efficient, digital connected mediums and where the consumer is. If the consumer is spending disproportionate time on digital and transactions are happening there, why should the money continue to not follow? So the advertisers will shift the budgets, and both of these anchoring mega trends, which I think none of us can debate against, provide me the clarity that, look, these markets will continue to grow. What's the difference between developed markets? Developed, the digital adoption has already reached a certain level of maturity, and digital advertising as a percentage of total ads is already more than 50%. So, one could see a clear difference between developed markets adoption curve on both the consumer and the advertiser side, as well as emerging markets. There's a big difference. And therefore, I'm very confident at the industry outlook. And then within that, I'm wanting to assure myself that our team, our platforms, our business model is competitive versus other players, and therefore maybe grow faster than the industry average growth. So this is my only thesis. It's grounded in reality.
But would you not express a surprise at the speed with which the developed market seems to be kind of getting muddled? It's one thing about maturity of the markets in the developed markets and relatively higher penetration of digital. But the speed at which the whole space seems to become chaotic, is that a source of surprise, or do you think it is quite in the nature of things?
Well, I think, look, first of all, I don't know the adjectives muddled and chaotic. I mean, to me, I can see sense in what is happening in developed markets. I think the customers are feeling wary of inflation, of employment, the cost and efficiency. There's so many factors moving there, right from currencies to, in Europe, we already know there's all kinds of geopolitical factors and so on. So I think there is conservatism, but that does not mean that digital advertising will not deliver growth. Now, if you're looking at some examples, let's say, the big tech. The big tech, if your question is coming from how quickly Meta or Facebook has gone from where they were to where they are, if your question is born out of that, then I think you have to just start from looking at our own homes. Which teenagers are spending time on Facebook? I don't see that happening as much. And it is still the older people who were once on Facebook and as a habit and inertia continue on Facebook. I think the consumer pull of that has gone, and that's why there was a need for Facebook to shift from Facebook to Meta to something else and that something else hasn't materialized as per the expectations that they set, and therefore they are seeing a massive hit in terms of confidence levels and otherwise. And of course, Apple has done certain changes which is impacting them. Looking at them as an isolated case is not shaking my thesis and belief of digital advertising as a clear trend, even in developed markets. That I think the overall industry on digital, first of all, advertising is resilient. Digital advertising will be resilient, and if there is a recessionary uncertainty, of course, some budgets will shrink. And I think that is something to be expected. Now, we are fortunate that we are focused on emerging markets where such recessionary backdrops are weaker, and they're not, we are not seeing as much impact in emerging markets, and therefore Apple is in a good place. But is it making me nervous looking at US and Europe that, oh my God, what is happening there, the speed or muddled or this? No, not at all, sir. I can understand what is happening there, and I can understand what is happening at Meta, and I'm still bullish. In fact, I think that if this kind of fear of recession continues, it should strengthen Apple's ability to find value-driven strategic M&A consolidation opportunities in developed markets also, and we will keep an eye out for that. I will be very careful and realistic about what we execute on, but I see an opportunity for us that when markets are down, we should go ahead and look at strategic acquisitions and look at value-driven deals, because we'll find them cheaper in this time. So we need to look at our execution strategy, say where there's turbulence, how do we navigate? Where there is, so in emerging markets, we need to grow. In developed markets, we need to navigate into that turbulence carefully and find opportunities to become stronger. So that's how I see it. And I wouldn't necessarily agree that the speed and the space is all muddled and become, it's not so dire a situation at all. Meta is just one example, and we can decode that, and we can understand that.
No, thank you very much. That's clear.
Thank you. The next question is from the line of Ashwin Mehta from Ambit Capital. Please go ahead.
Hi, thanks for the opportunity. Anuj, in terms of employee costs this quarter saw an increase. So what were the areas of investment there, and does this increase continue near term, or most of it will start to give us leverage as we go forward? And the second question was to Kapil in terms of the levels of intangible capitalization in this quarter and any outlook on the DNA going forward, which saw some increase this quarter.
Right. I think the employee cost wise, we are basically following our growth plan, an organic growth plan, and investing into the areas, whether it is sales and on-ground presence in emerging markets and other emerging markets, as well as going for deeper verticalization and therefore focusing on teams which are verticalizing our platform even further to unlock more strategic value, so we can be giving more ROI to the advertisers and drive more profitability from those verticals. So I think this is in line with our approach and the strengthening of our own moat and backing it up. And I think what I want my investors and the analysts to look at is that when the company is capable of backing its strategy and delivering resilient results, it's a sign of confidence. If you had seen that Apple is delivering better bottom line margin expansion at the back of OPEX reduction, I would not be celebrating that. The only reason to celebrate this Q2 result is to say 20% plus EBITDA, while OPEX was being increased and investing in areas of growth. So clearly the company is bullish, it is doing the right things, and it is seeing financial fundamentals in its unit economics, that when it grows, it delivers margin expansion. I think that is what I want to emphasize upon. And I think the employee cost is broad-based, backing our strategy of verticalization, emerging markets, and having on-ground presence. For the second part of your question, I'll pass it over to Kapil.
Hi, Ashwin. So our capitalization on intangible for the newer product lines or the newer models is almost similar to the Q1 in around $2.2 to $2.3 million.
Okay. Just to follow up.
There is no major shift. There is no major shift from Q1 to Q2.
Okay. Okay. And does the increase in terms of amortization largely happen because of translation for us, or there is anything else?
So if you see the amortization comparison from last year to this year, you would have seen a significant change as we go forward because it catches up, right? So there is in the PBT you will see about 4 to 5 crore rupees differential on the amortization from the previous Y-on-Y basis. So you can see that catching up effect in this quarter itself on a year-on-year basis.
And Anuj, if I could just squeeze one more in, so we saw your data and inventory costs come off this quarter. So is it largely because of the JAMS efficiency starting to play out? Any perspectives on where are we in the journey of JAMS profitability approaching our own profitability?
I think it is, our emphasis is on profitability and productivity and the strengthening of partnerships. And I think we are looking at multiple legs of it. We're looking at, profitability per employee, per team member, or, people call it productivity per employee. We look at it from the lens of profitability of each region, profitability of each vertical, and so on and so forth. With respect to JAM, I think the emphasis even was always there because year 2 and year 3 is about maximizing profitability and some of the rationalization of revenue, which we talked about the $3 to $4 million in H1 that we would have made incrementally more had it not been for the headwinds, right? I think that is bringing a deeper urgency across the organization to ensure that, hey, if there is anything left to be done, can I please do it, right? I mean, can I make sure that pricing is better, my margin is better? What else can I integrate within the core tech stack of the company to leverage that? What's happening in, let's say, Southeast Asia or in India that can be implemented even better in Latin America or in Africa? So there is a lot of internal huddle towards that. And I think that is a positive thing. Will I want to quantify JAM's profitability percentage for you at this call? Perhaps not, because we are still finding that balance, because in developed markets, some of the revenues are not there and so on. So let us look at it on a more broad basis by the end of this year. Yeah.
But sure. Thanks, Anuj, all the way.
With JAM, qualitatively speaking, I think one of the investors had asked me, and it was a hypothetical question, that if you had to pay more for JAM now with the hindsight of having owned it for a year, 1 year ago, would you do that? And the answer is yes. I think it's a strong asset, and it's worked well for us.
Thanks. Good to hear, Anuj. All the best.
Yeah.
Thank you. The next question is from the line of Arun Prasad from Spark Capital. Please go ahead.
Thanks.
Mr. Arun, sorry to interrupt. We cannot hear you, sir.
Hopefully now it is better.
Yes, please go ahead.
Okay. Thanks for the opportunity. My first question to Anuj. So we are. I take your point that emerging market is strong and developed markets we are facing some macro headwinds. But if you see our own numbers, if you see the India segment top line, sequentially it has grown at 10%, but year on year it is more like a 20%. We are used to see this number at much higher, say 30-35%. So are we really seeing any growth slowdown in India as well at the category level, or is it like more like a some high base issue in the base quarter issues?
I think the way to look at India right now is certainly on sequential basis, and the reason why I emphasize that is because the headwinds and related issues are primarily sort of common across H1 and Q1 and Q2. And when we look at emerging markets doing better versus developed markets, that thesis can only be analyzed on a sequential basis, not on a year-on-year basis. Now, in terms of year-on-year basis, when you start looking at it and you say, oh, how come India is only growing in the 20-odd% and not 30 or 40-odd%? I think there are also India or emerging market specific issues, which I think we are quite resilient against any which ways, and I've talked about this before as well. If one of the verticals, let's say EdTech or crypto or FinTech is down, I think Affle is able to still get enough conversions sold and delivered to other industry verticals in our ecosystem. And because we have broad-based growth, we are able to capture that. In one particular quarter, if one vertical is impacted, one area, there is suddenly a negative trend. Like during COVID times, there was travel and transport, hospitality was down, retail was down. Now that is coming back up, like with a vengeance. And on the other hand, we have, education tech and fintech, the crypto side of fintech and so on. These issues will happen. And in a fast-growing company, in some quarter you'll see 30% in one area, and suddenly you cannot expect every quarter will be 30%. It could be 26 in another, and so on and so forth. So I think we have to see longer-term trends and averages. I wouldn't read into that as, India is growing slower and there is a problem. I would read into that as whatever India was at 6 months ago and where India is at today, look at the sequential trend, quarter on quarter. This is moving nicely. Okay, and that's how we should see it. We should also keep in mind that this is at the back of a lot of startups not getting funding. There's all kinds of issues, and yet Affle is able to be resilient because our base of advertisers is wide, and there's always this emphasis within Affle to have broad-based growth across advertisers, across verticals. Whenever there is any customer concentration that's building up, that's a risk that I want to cure as soon as possible, right? So I think that's another peek into our mindset, and therefore, please analyze India in that light. And if you're looking at forward-looking modeling, then my guidance has always been clear, pre-IPO, post-IPO, every other call, that I expect 25% CAGR growth for the industry, and therefore I want to peg against that.
That's helpful, Anuj. My second question is related to the forex, the kind of fluctuations or volatility or depreciation we have seen in this quarter. Generally speaking, keeping aside the accounting for a moment, I mean, where we are booking in which line item, generally for a business, is rupee depreciation is good for you or bad for you? And as a follow-up to that, I would also like to understand what would be the constant currency growth that you had for Q2 in revenue as well as at the bottom line level. If you can share that will also be very helpful. Yeah.
Anuj, I'll take this.
Yeah, please go ahead. Yeah.
So, you have to understand the business of Affle is very diverse in emerging markets where the billing happens in the local currency, right? To give you a statement that the currency movement is advantageous or disadvantageous, it depends on which currency movement is happening, right? So there are where we have disadvantage on currency movement because of the dollar getting stronger, and there is some advantage on the dollar side. So largely, at the moment, if I say it, on an average basis, we would be mostly neutral to it. The costs are generally in dollars, so there is a pressure on the cost on the dollars, but it gets neutralized on the other sides. So if you see at bottom line, the effect will be more muted on the currency movements, as we are quite hedged with a lot of currency billings we have in the emerging markets as well as in India. Right. So, and on your question of constant currency, we have historically not presented a constant currency